The rise of AI has Wall Street worried about the notion that AI eating software. This phrase reflects the fear that self-coding AI agents could disrupt traditional enterprise SaaS companies like Workday, ServiceNow, Salesforce, and SAP. In today's video, I will break down whether AI is truly eating software and why I've been buying one beaten down software stock and continue to accumulate. This channel is all about investing and personal finance to help you retire early. The stock I've been adding to my portfolio lately is Salesforce, best known for its industry-leading CRM platform. Investors are mainly concerned about Salesforce's future in two key areas. First, AI can now write code by itself, meaning companies might eventually replace their existing CRM systems with self-built or AI-native solutions. Second, as AI continues to automate human jobs, Salesforce's business model could come under pressure, especially after it laid off about 4,000 customer service employees, replacing them with its own AI-powered Dreamforce platform. Since Salesforce's core revenue depends on recurring subscription fees tied to user seats, fewer employees at client companies could translate into fewer paid users and ultimately lower recurring revenue. Sure, these are legitimate concerns, but let's dig a little bit deeper to see how real the risks are and how Salesforce is actively addressing them. Before I retired, I served as regional head of IT for a global industrial company, leading major technology projects and system rollouts to improve productivity and growth. We relied heavily on cloud-based SaaS applications to manage everything from product design, sales, and manufacturing to aftermarket services, as well as internal operations like finance and HR. No single software application could meet all of the company's needs. Each business process had unique requirements, so most systems had to be reconfigured or customized, often with additional coding. With the lean IT team, we outsourced most project implementations and application deployments to third-party providers. A common approach among large global enterprises, many of which are Salesforce clients. Even if AI can code, the chances that these enterprises will start developing their own CRMs or ERPs are extremely low. Here's why. Internal-facing applications are built to manage operations. They don't directly generate revenue. It's often not in the company's best interest to build in-house expertise for developing such systems, whether through AI or internal teams. Strategically, most leave that to industrial IT experts. Larger organizations in particular prefer proven enterprise-grade platforms like Salesforce and SAP, which can scale as their business grow while meeting strict security and financial control requirements. Beyond that, these enterprise systems are highly complex and deeply embedded in the company's operations and the IT ecosystem. Replacing them, whether a CRM or ERP platform, is a massive organization-wide effort that's not only costly in terms of time and manpower, but also highly risky. It can often disrupt a business for months and in some cases even shut down operations entirely. Trust me, as a former IT executive, I've seen it firsthand. All that effort just to cut IT costs and recreate a like-for-like system built by AI without adding any real business value. Is that really any CEO's priority? I'd rather invest that money and effort into improving the current system, increasing user adoption, and advancing AI-driven data intelligence through solutions like Palantir or Salesforce itself to deliver real business benefits. While AI's self-coding abilities are impressive, they are more likely to enhance enterprise software than replace it. AI can significantly reduce the time required for configuration and customization, turning what once took days or weeks into just minutes or hours. At Salesforce 2025 Dreamforce event in San Francisco, the company demonstrated these AI self-coding capabilities through Agentforce Vibes. This innovation allows Salesforce to deliver faster implementations and greater customer satisfaction, ultimately strengthening, not weakening, its market position. Regarding the second concern, the potential reduction in user seats as companies adapt AI, there's indeed some impact. Certain back office roles will be replaced by AI agents. Tasks like tracking orders or checking production status that once required employees to search through ERP systems can now be automated. The same applies to many customer case management positions. But here's what a lot of people miss. Those roles aren't the core drivers of Salesforce recurring revenue. I don't recall in a single management meeting where our general managers talked about cutting their sales staff. On the contrary, to keep growing the business, we constantly opened new territories and developed new verticals. Business cases were frequently presented to our president, calling for additional investment in salespeople and service technicians. These are exactly the roles that Salesforce core products are designed to empower. Its CRM suite manages the entire sales cycle, from marketing and lead generation to coding and contract management. Its field service suite handles repair orders, dispatching, parts, and maintenance. With AI-enabled Agentforce making these teams' jobs easier and far more productive, they can now focus on what matters most, serving customers. In nearly every company, sales and service are the group that directly drive revenue. So while AI may trim some back office jobs, I believe companies will actually expand their sales and service teams and invest more in AI agents, creating an upward spiral of productivity and growth. That's great news for Salesforce. It strengthens its core business through new user subscriptions and accelerates AI-driven revenue growth. Management's latest guidance confirms this outlook, projecting more than $60 billion in revenue by fiscal 2030 and targeting a compound annual growth rate above 10% from $41 billion in fiscal 2026. In its latest Q2 earnings report, AI and data cloud related revenue surged 120% year over year to $1.2 billion, while the rest of the business grew at a modest 3% to $9 billion. If AI and data revenue grows at 50% annual rate, even with the traditional business remaining flat, Salesforce quarterly revenue from these segments could approach $6 billion by fiscal 2030. That would bring the total quarterly revenue to $15 billion, or about $60 billion annually, aligning perfectly with the latest management's long-term target. Given the company's triple-digit AI and data revenue growth in Q2, improving margins from internal AI adoption, and steadily core business expansion, I think management's guidance is still conservative. At Dreamforce, CEO Mark Benioff rebranded Agentforce to Agentforce 360, positioning it as the foundational platform of Salesforce ecosystem, a new AI operating system that unifies all of its product lines and defines the company's next strategic phase. This strategy isn't so different from OpenAI's. If you watched this year's OpenAI developer conference, it's clear that their goal is to integrate ChatGPT and other AI tools into as many existing web application ecosystems as possible, from Spotify and Zillow to Salesforce's own Slack. This isn't AI eating software, it's AI operating software, much like humans do today. It doesn't stop there. Salesforce is expanding into supply chain management, IT service management, and even defense sector, with a new division called Mission Force that directly competes with established players like Palantir, SAP, Oracle, and ServiceNow. At the same event, Dell announced it had onboarded over 20,000 suppliers onto Salesforce's supply chain platform, a clear sign of Salesforce's growing enterprise footprint. While many fear that AI would eat software, disrupting traditional SaaS companies, Salesforce's business process-centric model and strong ecosystem, powered by its AI-driven Agentforce platform strategy and its recent acquisition of Informatica for advanced data integration, sets it apart from the rest. From my perspective, it has what it takes to evolve into a true AI software leader in productivity, automation, and data intelligence. Of course, I never buy a company without validating its fundamentals first. According to my stock ranking system, Salesforce currently scores a solid 74 points, comparable to Apple and Google, but below top performers like Nvidia and Meta. Salesforce maintains high gross and operating margins, a strong balance sheet with low debt, and an excellent free cash flow conversion ratio of 1.21. However, it scores lower due to mediocre return on equity and moderate EPS growth rates. The low ROE is due to high equity relative to net income, but this should improve as share buybacks reduce equity and AI-driven productivity boosts operating margins. I assumed a slightly conservative 12% EPS growth rate, even though Q2 EPS rose 14% year over year and Q3 is projected to increase by 19%. With this in mind, let's now estimate the intrinsic value of Salesforce stock. Based on the following assumptions, a beta of 1.25, a 5-year EPS growth rate of 12%, annualized non-GAAP EPS of $11.13, and a terminal PE ratio of 17.9, I calculate an intrinsic value of $312 per share, compared to the current price of roughly $255. That represents an attractive 22% discount. At a 12% annual growth rate, my 1-year target price is around $350. If you like to use my stock ranking system and the discounted EPS model for your own analysis, join my Patreon community through the 6 months free access promotion in the pinned comment below. As a member, you will get exclusive content, real-time portfolio updates, and much more. In closing, the emergence of new technology often disrupts companies that resist change, while empowering those that embrace it and continue to innovate and evolve. So which kind of company do you think Salesforce is?